The screen says one thing, the vault says another. And right now, Shanghai is screaming a number that the Western world is pretending doesn't exist. While you were sleeping, while New York was closed, while the algorithms were quiet, the Shanghai Futures Exchange opened in the morning and silver didn't just rise, it exploded. The price hit 23,419 Yuan per kilogram. That translates to $105 per ounce. $105 for physical silver in the world's largest manufacturing economy. Now look at your screen in New York. The Comex spot price is hovering around $89. That's a spread of $16. $16 separating the paper promise in Manhattan from the physical reality in Shanghai. This isn't a premium anymore. This is a declaration. China has stopped playing the Western pricing game. They're not waiting for London to fix the price. They're not waiting for JP Morgan to decide what silver is worth. They're bidding what they need to bid to get the metal. And what they're bidding is telling you everything you need to know about what's coming next. Because when the world's factory floor is willing to pay $105 for an ounce of silver while the paper market pretends it is worth 89, one of two things is about to happen. Either New York wakes up and chases Shanghai higher, or the entire global pricing mechanism shatters completely. The arbitrage isn't closing, the gap is widening. And the smart money stopped asking why weeks ago. They're just buying everything they can find before the rest of the world figures out what Shanghai already knows. Let me show you exactly what happened overnight. Let me show you why this 16 premium is the most important number in the commodity markets right now. And let me show you why the people who are still waiting for a pullback are about to learn a very expensive lesson about the difference between a chart and reality. The Shanghai Futures Exchange operates on a different clock than New York. When the Comex closes on Monday afternoon, Shanghai is already into Tuesday morning. And this Tuesday, February 4th, 2026, the Chinese market opened to a feeding frenzy. The opening price for the March silver contract was 22,147 Yuan per kilogram. Convert those numbers. At the current exchange rate of roughly 7.05 Yuan to the dollar, 23,419 Yuan per kilogram equals 105.32 per troy ounce. Meanwhile, Comex futures in New York closed Monday at 89.15. The spread, 16/17. This is not the largest premium we've seen, but it's the most persistent. 3 weeks ago, when Shanghai first crossed $100, the premium was $18. New York rallied in response, closing the gap to $12 within 48 hours. Then it happened again. Shanghai pushed higher, New York followed. The pattern repeated. But this time, something changed. The premium is no longer compressing. It's stabilizing above $15. This tells you that the arbitrage isn't working anymore. The mechanism that's supposed to equalize prices across global markets, the mechanism where traders buy cheap in one location and sell expensive in another, has broken down. Why? Because the metal isn't moving. You can't arbitrage what you can't ship. You can't close a spread if the physical bars are locked inside Chinese borders and Chinese factories are consuming them faster than the refineries can produce them. Look at the industrial demand data. China manufactures over 80% of the world's solar panels. Every single panel requires silver paste for conductivity. The new TOPCon and heterojunction technologies use 30% to 50% more silver per watt than previous generations. And China's domestic solar installations are accelerating. The government just announced another round of renewable energy subsidies targeting rural electrification. Provincial governments are competing to meet carbon neutrality targets. The demand isn't speculative, it's structural. It's factories signing purchase orders for hundreds of thousands of ounces, not to trade, but to consume, to turn into products that will never release that silver back into the market. Then there's the battery sector. Silver zinc batteries are gaining traction in grid storage applications because they outperform lithium in specific use cases. Chinese battery manufacturers are scaling production. They need silver oxide. They need it in tonnage quantities. And they're competing with the solar manufacturers, the electronics producers, and the defense contractors for the same shrinking pool of available metal. This is why the premium exists. It's not irrational exuberance. It's supply and demand hitting a wall. But there's another force at work here that the mainstream financial press refuses to acknowledge: strategic accumulation. For the past 18 months, Chinese state-owned enterprises have been quietly building silver reserves, not for immediate industrial use, but for long-term security. The same way they stockpiled rare earth elements, the same way they locked down lithium supply chains, they're now doing with silver. Because silver is dual use. It's an industrial metal and a monetary metal. And in a world where currency wars are fought through export controls and supply chain dominance, owning the metal gives you leverage. When the United States talks about reshoring critical mineral supply chains, when Europe scrambles to secure raw materials for its Green Deal, they're discovering that the silver they assumed would always be available at a reasonable price is suddenly expensive and scarce. And the country that controls the refining capacity, the country that processes 60% of the world's mined silver, has decided that domestic demand comes first. China isn't banning exports. They're just making it economically unviable. When the domestic price is $105 and the export price has to be competitive with that, Western buyers face a simple reality: pay up or go without. This is where the Comex price becomes a fiction. The paper market in New York is trading contracts that represent silver. But those contracts are increasingly disconnected from the physical metal those contracts are supposed to represent. The registered inventory at Comex, the silver that's actually available for delivery against futures contracts, has been hovering around 38 million ounces. Sounds like a lot until you realize that global industrial consumption is over 600 million ounces annually. The Comex holds less than 7% of 1 year's demand. And that 38 million is shrinking, not growing. Every time a contract holder stands for delivery, metal leaves the vault. And replacement metal is harder to find because the refineries are shipping to Shanghai, where the bid is 16 higher. The vault is being drained by the gravitational pull of the Eastern premium. And once that vault drops below a critical threshold, once the market loses confidence that delivery is guaranteed, the paper price becomes meaningless. You can't deliver promises. You can only deliver ounces, and the ounces are in Shanghai. Now, the skeptics will point to history. They'll say premiums always compress. They'll say arbitrage always works. They'll say this is just temporary dislocation caused by logistics or currency fluctuations. But those explanations don't hold up under scrutiny. Logistics haven't changed. Shipping times from London to Shanghai are the same as they were 6 months ago. Currency fluctuations don't explain a $16 spread that persists for weeks. The Yuan hasn't strengthened 18% against the dollar. The explanation is simpler and more uncomfortable. Demand in China has structurally exceeded available supply at the Western price. The only way to clear the market is for the Western price to rise to meet the Eastern price. This is the same dynamic that played out in rare earth elements a decade ago. China produced 90% of global supply, consumed 70% domestically, and exported the rest. Then domestic demand grew. Exports tightened. Prices spiked. The West scrambled to develop alternative sources. It took years. Mines that were uneconomical at $50 per kilogram became viable at $300 per kilogram. But the transition was painful and expensive. Silver is following the same script. The difference is that silver mines take 5 to 10 years to develop. There is no quick supply response. So what does this mean for the global market? It means the Comex price is lagging reality. It means $89 is an artificial construct maintained by paper trading that ignores the physical tightness. It means that eventually the paper price will have to chase the physical price, or the paper market will lose all credibility. And when that happens, when New York finally accepts that Shanghai sets the price, the adjustment won't be gradual. It will be violent. Because once the perception shifts, once the institutional money realizes that the real price is $105 and not $89, the rush to reposition will overwhelm the available liquidity. Look at the volume data from Shanghai this morning. Over 47,000 contracts traded in the first 3 hours. That's 235,000 kilograms, roughly 7.5 million ounces. Compared to Comex, where daily volume averages around 80,000 to 100,000 contracts, Shanghai is seeing proportionally higher activity. The Chinese market is deepening. It's becoming the price discovery mechanism. And price discovery is power. Whoever sets the price controls the market. For decades, that was London and New York. The transition is happening now. This also explains why physical premiums in Western markets are rising despite the Comex price appearing stable. Dealers in Europe and North America are seeing the Shanghai price. They know that if they sell a bar for $92, they'll have to replace it at a higher cost when the next shipment arrives from the refinery. So they're widening spreads, raising premiums, and in some cases, simply refusing to sell at the Comex price. The street price is diverging from the screen price. When you call a dealer today and ask for a quote, they're not looking at the Comex. They're looking at Shanghai, and they're adding their margin on top of that. The Federal Reserve and the U.S. Treasury are watching this carefully. A commodity priced in Yuan trading at a significant premium to the dollar price is a challenge to dollar dominance. It suggests that the Yuan price is more reliable, more connected to physical reality. If this pattern spreads to other commodities, if oil or copper or aluminum start showing persistent premiums in Yuan-denominated exchanges, the implications for the global reserve currency system are profound. This isn't about conspiracy, it's about market mechanics, capital flows to where value is recognized. If Shanghai recognizes value at $105 and New York recognizes value at $89, capital flows east. The window to act is narrowing, not because of panic, but because of arithmetic. The spread between 89 and 105 is 60 needs. That 16 represents the mispricing in the Western market. It represents the opportunity to acquire an asset below its clearing price in the world's largest consuming market. History shows that these mispricings don't last. They get arbitraged away, or they trigger a repricing event. Either outcome means the Western price rises. The only question is speed. Does it rise gradually over months as the Comex slowly acknowledges reality? Or does it gap up overnight when a major institutional buyer decides they can't wait and hits the market with size? Shanghai just sent a signal. The price is $105. That's not speculation. That's the number printed on the exchange, verified by participants and cleared through the system. The metal is changing hands at that price. Real buyers are paying it. Real sellers are receiving it. That makes it real. And when the real price is $16 higher than the paper price is wrong. It's not a matter of opinion, it's math. The market will correct. The only choice you have is whether you position before the correction or after. The vaults above $100 are open. Shanghai is buying. The premium is widening. And the message is clear. The era of Western price dominance in silver is ending. The new benchmark is being set in the East, and the West is being forced to follow. The squeeze isn't coming, it's here. The only question left is whether you're positioned for what happens when New York finally admits what Shanghai already knows.